Hello, everybody, and welcome. So today we're going to be going through and looking at basically a question involving the lower of cost or market. This is going to be a very basic type of question for lower division financial accounting. So I am the accounting professor, Bennett Tchaikovsky. This presentation is copyright to 2008 to 2024. All rights are reserved. Any redistribution is expressly prohibited without my prior written permission. Opinions expressed herein are those of myself and not my employers, including but not limited to Irvine Valley College and the South Orange County Community College District. Okay, so coming over here, so we have gym, tanning, and laundry had the following inventory as of December 31st, 2028. And we're basically being asked what value should inventory be reported on GTL's balance sheet. So when we're dealing with inventory, one of the things, and I always use this as an example, is say what was so say if I bought, and we'll go back to 2012. So we purchased 5,000 iPhone 5s on one, or we'll call this on 12/31/2012, at a cost of $300 each. So if I looked at when we purchase inventory, so I would have basically debited inventory and I would have credited cash. I would have done this for basically 5,000 times 300. And then over here, to record purchase of inventory. Now, I want us to imagine the situation that we're now in 2024, and we'll say that, call it whatever, the 64 gigabyte model. But when we get to 2024, if I go to the eBay and I saw iPhone 5, and I look over here at an iPhone 5, basically pre-owned Apple iPhone 5s, we'll call it 30 bucks each. So the value of these iPhones are now $30 each. So if I never sold one, I have 5,000 of these. So the value of it is now basically about 10% of what it was new. And as I look at this, here's the problem I run into. If I show inventory on my balance sheet, right? So we've got our assets, liabilities, owner's equity. If I'm showing inventory as a current asset of 1.5 million as of 12/31/12, that's fine. But if I show this as of 12/31/24, I'm probably committing some sort of a crime because the inventory is not worth that anymore. So what I'm going to have to do is we apply something called the lower of cost or market. Okay, so when we're applying the lower of cost or market, there's a couple different ways you can do it. You can do it in terms of categories of inventory products, meaning that we had, say, I don't know, we had, if we're looking at cars, maybe we had trucks, maybe we have, if we're selling vehicles, maybe trucks, RVs, who knows? You can do things in groups. You can do things in the aggregate. Like, so if we had a supply of oil that we're going through and selling, and then you can use individually. So the way we're going to go through and do this is we're going to do things individually. So let's just cue a few other things right now. So the value in terms of this inventory on our books as of right now is going to be how much? Well, let's just kind of ignore the market value here just for a moment. And as I'm going through this, I'm going to go ahead and duplicate this. Okay. So I'm just going to pause real quick. So the value of this presently is going to be, well, I have 8,000 units at 18 per unit. And if I continue on down here, so the value of my inventory is almost $1 million. There you go, the Jersey Shore. That's about what it's worth. Okay, so as I come over here, so this is what the inventory is sitting at on my books. Now, what I'm basically is like, this is kind of like how I'm representing to my investors, because remember, when we were preparing financial statements, these financial statements are going to be used by investors and other parties to basically make decisions about whether they should invest in our company. So Apple, actually, I'll do a little bit of a better example. Let's go take a look at the Home Depot. I don't look at them apparently enough. So when I go to the depot and I look at right over here, inventory is about $23 billion. So if I'm the Home Depot and I'm putting this onto my financial statements, it's almost about a third of my balance sheet. So I want to make sure that the amount that is on here is correct, basically shows at the lower of cost or market, or I am not overstating my inventory. So my key here is I don't want to overstate inventory. So in order to do that, we're going to go through over here and we're going to look to see if we need an adjustment. Okay. So here's what we're looking for. We're doing things at the lower of cost or market. So if the BB is less than the DD, no adjustment because inventory is being shown at the lower of cost or market. So, however, if BB is greater than DD, excuse me, we're going to have to make an adjustment on a per unit basis. Okay. So coming right over here, what we're going to go through and do is say adjustment. Okay. So for this, the cost per unit is less than the market value per unit. No adjustment. Okay. Over here, the cost per unit is greater than the market value per unit of 3. So we're going to have to make an adjustment. Over here, the cost per unit of 41 is greater than 5, which is the market value per unit. So we're going to have to make an adjustment for the situation. Over here, for Sammy or Sweetheart, 8 is less than the market value. No adjustment. Over here for Vinny, basically my 11 is less than the market price of 14, so no adjustment. Over here for Ronnie, the 13 is greater than the market value. We're going to have to make an adjustment. And lastly, for JWoww, the market or the cost per unit is greater than the market value. So we're going to have to go through and make an adjustment. So on these items here, for Snooky, for the situation, and then for Ronnie and JWoww, I'm going to have to go through and make adjustments. For Paulie, Sweetheart, and Vinny, I don't do anything with these. So the first step we want to go through and do is identify those items that need an adjustment. So now, what is going to be the amount of the adjustment? So my per unit adjustment is essentially going to be, for ourselves more room, is going to be for those items that need adjustment. It is going to be the difference between the cost per unit less the market value per unit, or EE. So if adjustment, there we go. So over here, my per unit adjustment is going to be 19, or 22 minus 3 is 19. 41 minus 5 is 36. 13 minus 9 is 4. And then 6 minus 1 is 5. So that's my per unit adjustment. Remember, this is per unit. So to figure out the dollar value collectively of the adjustment, I need to take the per unit adjustment times the number of units, or EE, which is BD minus DD equals EE, times the number of units. So right over here, the number of units. So at this point in time, I'm going to say, okay, this is going to be 9,000 times 19, or 171,000. This is going to be 10,000 times 36, or 360,000. So over here, this is going to be 10,000 times 36. Over here, this is going to be 3,000 times 4. And for JWoww, this is going to be 7,000 times 5, or 35,000. Okay, so right over here, the total amount of my adjustment that I'm going to need is going to be 578,000, right? So when I look at this, right, so what value should inventory be reported at on GTL's balance sheet? Well, it's not going to be 995, right? And if we go down here and do our first part of this, so this is our adjustment total. I'm going to do this a little bit of a different order. Assuming that any adjustment to inventory is immaterial, meaning it won't make a difference if it's a smaller amount relative to the entire balance sheet, prepare the journal entry to report inventory at the lower of cost or market. So over here, 12/31/28. And by the way, what does material mean? Well, if I look over here at 96 billion, if something with other current assets were to be, say, if this were to be written off, is it material? Uh, Probably not really. If I was writing off inventory, which is almost, a third of the balance sheet, is that material? That answer would be yes. So there you go. So now, if and again, this is for lower division financial accounting. If you're taking an upper division financial accounting class, I have many other videos on this. Send me a link below and I'll send you over the link, because when we're doing this, basically the market value in intermediate accounting is determined by the middle of replacement cost, net realizable value, and then net realizable value minus a normal profit margin. That defines the middle value of those three defines market. So over here, we got account, debit, credit. So I'm going to credit inventory because my inventory account is being overstated by 578,000, right? So my inventory right now, inventory is an asset, right? So my inventory account pre any type of adjustment, the balance was 995,000. So this amount is overstated. So what I'm going to have to go through and do is I'm going to adjust it by 578. So I'm going to credit inventory. Now, in terms of what I go through and debit, if the amount is not significant to the income statement, I'm going to go ahead and debit cost of goods sold. The materiality thing in this part is very, very important because there's a different way we can go through and do this. Also, instead of crediting inventory, I could credit a contra asset account, basically inventory allowances, right? Or something along where you're going to basically be reducing the inventory for different types of adjustments, like a contra asset account. If you're taking my class, I am okay with you directly crediting inventory. Last thing I need over here to adjust inventory to the lower of cost or market. Okay. That's what I'm looking for over here. So there's a couple different ways you can do these problems, but this is the way I'm going through and doing it. Now, when we look at what value should inventory be reported on GTL's balance sheet, when I come over here, I say, okay, my inventory was at 995. After the adjustments, it's now at 417. So what value should inventory be reported at on GTL's balance sheet? It's going to be 417,000. So this is a quick question involving lower of cost or market, just kind of go through and introduce you to how we go through and do these things. So in any event, thank you for being with me here today. I look forward to seeing you on future videos and have a great rest of your day. See you soon.